Welcome to the Business Short Course series presented by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. This course covers the financial statement called the balance sheet. We will start the course with a quote from Warren Buffett, Chairman and CEO of Berkshire Hathaway. We will reject interesting opportunities rather than over-leverage our balance sheet. This quote, including the terms leverage and balance sheet, will be better understood by the end of this course. The balance sheet, also known as the statement of financial position, provides a snapshot of a company's financial position at a specific point in time. Unlike other financial statements, it is cumulative in nature, reflecting the current balances of the company's accounts. The balance sheet consists of three main components: assets, liabilities, and equities. These elements are connected through the accounting equation: assets equal liabilities plus owner's equities. There are three major types of accounts on a balance sheet. The first are asset accounts. Assets are resources with economic value that a company owns. These can include things like cash, inventory, equipment, and investments. Essentially, assets are what you own. Next, we have liabilities. Liabilities represent what you owe. Examples of liabilities include accounts payable, interest payable, and unearned revenue. These are the financial obligations that the company needs to eventually settle. Finally, we have equity accounts. Equity is the difference between all the assets owned and all the liabilities owed. It can also represent the book value of a company. Examples of equity include owner's contributions and retained earnings. Important to note is the difference between current and non-current assets and liabilities. Current assets are resources a company expects to convert into cash or use within 1 year. Examples include cash, accounts receivable, and inventory. On the other hand, current liabilities are short-term obligations that the company needs to settle within a year, such as accounts payable and short-term loans. Moving on to non-current assets, these are long-term resources, also known as fixed assets, that are not easily converted to cash within a year. Examples include property, plant, and equipment. Similarly, non-current liabilities are long-term obligations that are due in 12 months or more, such as long-term loans and bonds payable. Liquidity is an important concept here. It refers to how easily an asset or security can be converted into cash. The easier it is to convert to cash, the more liquid the asset is. On the balance sheet, accounts are ordered from most to least liquid. Now let's move on to the structure of a balance sheet, starting with assets. First, let's look at current assets. These are listed first on the balance sheet and are resources a company expects to either use or convert to cash within 1 year. Next, we have long-term assets, which are listed after the current assets. These include vehicles, buildings, and equipment. Long-term assets are not as easily converted to cash. As stated before, on the balance sheet, accounts are ordered from most to least liquid. This is why current assets are listed before long-term assets. Finally, it is important to note that long-term assets are depreciated over time. This means their value is gradually reduced on the balance sheet to account for wear and tear or obsolescence. Depreciation will be further explored in a later course. Next in our review of the structure of a balance sheet is liabilities. First, let's look at current liabilities. These are listed first on the balance sheet and include obligations that need to be settled within 1 year. Examples of current liabilities are accounts payable, wages payable, and unearned revenue. Next, we have long-term liabilities, which are listed under current liabilities. These are obligations that are due in more than 1 year. Examples include long-term debt and deferred taxes. Just like with assets, the order of listing liabilities helps in understanding the company's short-term and long-term financial obligations. Last in our review of the structure of a balance sheet is the equity section. Equity is the business value if all assets were sold and all liabilities were paid off. Equity can include things such as owner's capital. Also known as paid-in capital, owner's capital represents the amount of money that the owners or shareholders have invested in the company. Retained earnings, which are the cumulative net earnings or profits that a company has retained rather than distributed to shareholders or owners as a dividend, and also net income, also known as net profit or net earnings. Net income is the total profit of a company after all expenses, including operating costs, interest, taxes, and other expenses, have been deducted from total revenue. I'm going to repeat this because it is a very important fundamental accounting concept. Assets always equal the sum of the liabilities and owner's equity accounts. Doing algebra, this equation can also be written as assets minus liabilities equal owner equity. In other words, what you own minus what you owe is one way to calculate the value of your company. Now let's discuss the importance of the balance sheet and how it can be used in various aspects of business management. First, the balance sheet can help determine if a company is over-leveraged. This means assessing whether the company has enough cash on hand to meet its current debt obligations. The balance sheet also helps track the company's performance over time. By comparing balance sheets from different periods, management can identify trends and make informed decisions about day-to-day operations and long-term strategy. Additionally, the balance sheet is essential for managing and planning budgets. It provides a clear picture of the company's financial position, which is vital for effective budgeting. Finally, the balance sheet is important for regulatory and legal compliance. It ensures that the company meets financial reporting requirements and adheres to relevant laws and regulations. Two ratios that can be calculated using the balance sheet are the debt-to-equity ratio and the working capital ratio. First, let's talk about the debt-to-equity ratio. This ratio measures the relative proportion of a company's debt to its shareholders' equity. It is calculated by dividing total liabilities by shareholders' equity. A higher ratio indicates that a company is more leveraged, which means it relies more on debt to finance its operations. This ratio is crucial for assessing the financial risk and stability of a company. Next, we have the working capital ratio, also known as the current ratio. This ratio measures a company's ability to pay off its short-term liabilities with its short-term assets. It is calculated by dividing current assets by current liabilities. A ratio above 1 indicates that the company has more current assets than current liabilities, which is a sign of good liquidity and financial health. Now that we have learned about the balance sheet and the concept of leverage, we can review this quote. Warren Buffett is saying that his company, Berkshire Hathaway, will choose to reject, to not invest, in interesting opportunities, potentially profitable businesses, if he thought that would mean Berkshire Hathaway would be over-leveraged. In other words, if investing in a business means Berkshire Hathaway would take on too much debt, Warren Buffett and the other managers at Berkshire Hathaway will choose to withhold their investment. Time for a pop quiz. Question 1. Which of the following are shown on the balance sheet? A. Asset, liability, and equity accounts. B. Income and expense accounts. C. Operating, investing, and financing activities. Or D. The sources of capital and the ways capital is being utilized. Question 2. Which of the following is true of assets? A. It is equal to expenses minus revenue. B. It is equal to total liabilities plus total owner's equity. C. It is equal to revenue minus expenses. Or D. Total assets is the sum of all equipment accounts. And question 3. Which of the following would you expect to see on a balance sheet? A. Cost of goods sold. B. Accounts receivable. C. Uses of funds. Or D. Net other income. If you need more time, feel free to pause the video. We'll show you the answers in just a few seconds. Here are the answers to the problems. Question 1. The answer is A. Asset, liability, and equity accounts are shown on the balance sheet. Question 2. The answer is B. Total assets is equal to the sum of total owner's equity and total liability. And question 3. The answer is B. Accounts receivable balances are shown on a balance sheet. Find the missing values highlighted on the balance sheet below. Total current assets, total fixed assets, total assets, total current liabilities, total long-term liabilities, total liabilities, total owner's equity, and the total liabilities and equity. As a reminder, the total liabilities and equity will equal total assets. The numbers that are in parentheses, like accumulated depreciation, are negative values. If you need extra time to determine each answer, feel free to pause the video now. If you wish to work out the solution by hand, a PDF of this practice problem is available for download at the website. We'll show the answers in just a few seconds. Here is the solution. Let's start with the assets section on the left. The total current assets amount is calculated as the sum of all current asset accounts. This adds to $40,000. The total fixed assets, which is the sum of the fixed asset accounts, is $760,000. As an aside, notice that accumulated depreciation is a negative amount. Depreciation is a way of accounting for wear and tear on equipment and will be examined during the depreciation course. Now that you have found total current and fixed assets, you can calculate that total assets equals $800,000. The total current asset percent is 5% and is calculated by taking the total current asset amount of $40,000 and dividing it by $800,000. The total fixed asset percent is calculated the same way by taking total fixed assets divided by total assets to get 95%. The liabilities and equity side of the balance sheet is calculated the same way as the assets section. The total current liabilities is calculated as the sum of all current liability accounts. Total long-term liabilities is the sum of all long-term liabilities. The total of all liabilities is the sum of both current and long-term liabilities. The total owner's equity is the sum of all equity accounts, and the total of liabilities and equity is the sum of the liability and equity subsections. The percents are all calculated as fractions of the $800,000 total of liabilities and equity. Finally, notice that the total of liabilities and equity equals the total of all assets, $800,000. A balance sheet is a financial statement that provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. It shows what the company owns and owes, as well as how much has been invested in the company by its owners. It provides insights into how a company's operations are financed, whether through debt, income, or other means. It is an essential tool with multiple uses that is valuable to all business owners. Thank you for listening to this presentation brought to you by the Iowa State University Extension and Outreach Farm, Food, and Enterprise Development Program. We're here to help you make informed and confident decisions for your business.